Right guys, welcome to a new video. So in this video, we're going to be talking all about risk management. I've had some people message me on Facebook just asking a little bit more about my sheet and how I calculate daily loss in terms of position sizing, also the number of trades, and obviously number of actual micros per position. So you can see here I have on the sheet, and this is custom to me in terms of my ATR stop loss on NQ, which is around 30 points. So anything you see in green is basically a 10-point variance, either high or low. So in this case, you can see if I take 3 trades with 1 micro, I can take a 33-point stop on 3 trades, and that'll be my $200 risk on 10k. If I put the account size to 30,000, you can see it then changes. So 30,000, my 2% risk will be 600. If I just took 1 trade with 1 micro, I could lose essentially 300 points on a trade, or it could go 300 points against me, and that would be my whole day done. 2 trades, you can see here it's showing 300 there as a 3-0 just purely because it's calculating the zeros on there as well instead of just the 30. But you can see here as well. So if I take 5 trades with 2 micros, it's saying that's green for me. That's an okay trade, or that's an okay position size. If I want to take 3 micros, I can only take 3 trades. If I want to take 5 micros, I can only take 2 trades, etc. So my limit in terms of micros is 5 in this case for a 30-point stop loss. And then you can see here a nice sweet spot if I want to take 5 trades. Why would you want to take 5 trades in a day? Well, if you, for example, have an idea, but it takes you a couple of trades to get that idea, you don't want to just go in heavy on 2 trades, lose, and then you could have got 3 or 4 trades, and that you could have got basically the idea materialize. It's just sometimes you have to obviously be patient for that entry, but also have to give the market a chance to actually set up as well. So sometimes you can be premature. It happens to some of us. So for me personally, I would much rather go lower on the size but have more entries. So 3 seems to be a sweet spot for me, all the way up until about 30k. So if I put this up to 50,000, and this is personal account, this isn't a prop firm account, this is actual funds, right? So if this was a prop account, you would actually have to put in your stop loss on that account. So if you're using like a 50k account, normally has a drawdown of around 2,500. This is where it gets kind of dicey, right? Because essentially for my system, in terms of 30-point stop losses on the NQ, it can get tricky. One micro is your risk is 2%. Of course, you can change your risk on here to 20% on these prop firms because you're risking a lot less. It's not your actual capital. Most of the time, you can get one of these accounts maybe 30 to maybe $100 on variance in terms of different companies, and then obviously you can risk $500, but that's when you're using 20%. So it's all how you structure your risk. This is just my personal account, which I'm using as an example. But like I say, you can alter this as much as you like. So just to go over this again, and then you've got some sort of goals here, which will calculate depending on the amount you put in. So for example, if you change this to 50,000, you can see here, the monthly goal is going to be basically the 50k divided by 12 months. And this is the goal divided by 50 weeks. So we have about 50 trading weeks in a year. And then the day is basically 250 days. So that is going to be the weekly goal divided by the profits. This is showing you I need basically, in a sense, 2 days, 2 decent days a week to get my goal. Obviously not taking any losses into account. So if I just had 2 good days in a week, essentially I don't need to trade for the rest of the week. Why give anything back? I've already hit that weekly goal, just for an example, right? That's showing an example there. So that's kind of what that's doing. You see here, for example, let's just put my account balance at the moment, which is my personal account, which I have 10,300. So you can see on here at the moment, all the ones that are in green are basically examples that I can use to trade. So you can see in this example, risk. So when I started this week, my account was at around I think like 8,900. So my risk was around $180 total. So I was taking 1 micro for about 3 trades. That was kind of my sweet spot. As the account has grown this week to 10,300, you can see now I can risk a little bit more. So I can risk, $206. And you can see once this gets to, let's say, 15,000, I can then risk $300. Once it gets to 20,000, I can risk 400, etc. So in this scenario at the moment, I can use 1 micro and take 5 trades. And you can just sort of see this one is the profit. So in terms of the stop loss on this one, it would probably be the free trades here for the $34 in 34 points on the trade. So that's kind of the one that I would be going for. And you can see here on the micros here, none that I can see that are including 30. So most likely, if I wanted to trade 2 micros, I'd be taking 2 trades at 26 points. So if we just go through that example, so if I take 26 points times 2 micros, then times that by 2 trades, and times that by 2 again, that's going to give me my 208, which is basically my my stop on the day. So you can see stop wise, it gets hard if I want to, you know, use 4 micros. You can see here 20, just one trade. So for example, 26 points on this one trade times 2, and then times 4 micros, you know, I'm done, 208 again. Okay, so in this scenario, it's probably best for me to use the 34 point stop. Obviously, this isn't me saying I'm going to get stopped out. It's just allowing that risk, allowing that room for the trade. So worst case scenario, 34 points times 2, and then times 3 trades, you know, 204. So that aligns with the stop. I'm not entirely sure why that one isn't coming up on the conditional format. It should be on there. There we go. I think it was like 34.5 or something, so it wasn't rounding up. So it's probably close more to yeah, so 34.33. So I rounded it up to 35. So in this scenario, you can see here, 3 trades is the sweet spot in terms of having that nice range. You guys who follow me and who are in the room know that we go for like 30, 50, 60, 100, 150 point trades. Not all the time, but my brackets are 30, 50, and 60. So my loss is 30 points. So I'm always getting for a 1.5 R. That's what you can see here, always a 1.5 R. If we just put this to 10,000 to keep it nice and easy, obviously you can see in this scenario, if I just have one trade, I can risk 100 points, which is $200, $2 per point on the NQ. So 100 points is $200. The profit in that scenario would obviously be 1.5 times. So you can see here, it's going to equal, you know, 1.5. So 150 points of profit. If I want to split that into 3 trades, I'm going for 33 point stop loss, which is what I normally go for, 30 points. And my profit is 50. In this scenario, I'd having to be going for basically 50 points on that one trade. Okay, so, and you can see in this scenario here, 2 trades, the stop would be 25 points, and I'd be going for 38 points on the profit. So always trying to go for 1.5 R. As the account grows, I'll be able to do what I want to do in terms of the risk. So as I mentioned before, my normal on my prop accounts, my normal strategy is basically stop is going to be 30 points. And then normally what I would have is T1, which will be 30 points as well. Okay, T2, which will be 50 points. And then T3, which will be 60 points. And if you add all of those up, okay, and then divide that by 3 positions, you'll see 47. So you'll see it's always around 1.5 R. This will be different if you're using a prop firm. For example, if you've got a 150k account like my Topstep one I just got, you know, I'll have $4,500 of risk, right? So I can't really risk 2% on that account. Since that account is essentially risk-free, if I get a payout, it costs me about $150. So, you know, I don't really mind risking a little bit more. So in this case, if you want to risk, you know, 20%, means you'd have to have 5 losing days in a row to blow that account, essentially. That allows you to now risk, you know, $900, which is a little bit more, gives you a bit more room to play with, right? A bit more risk. So in that scenario, I can use 3 micros and I can take 6 trades. And you can see that will be my stop, 25 points. If I want to lower this down to, let's say, 15% risk, you can see here my stop is at 23, so I haven't really got enough. I can use this one here, 34 points. So if I just put the conditional format on this one, you can now see in this scenario I can either use 5 or 6 trades, right? So that was most likely the 6 trades, because I don't normally hit 30-point stop losses, but of course they do happen sometimes. So if I do, I can take 6 trades on 2 micros, or I can take 5 trades with 3 micros in this scenario. So 28 points, 2 trades with 6 micros, 2 trades at 34 points risk at 5 micros, 28-point risk on 3 trades with 4 micros, 28-point risk on 4 trades with 3 micros. So you can see here, just using 1 micro means you have to take 1 less trade, basically. Hopefully I'm not going on about this too much, but just so you can kind of get a gist of how I would calculate risk in terms of position sizing, just to give you an overall feel for basically risk management. So just to go over the trade simulator and the reason why I get these numbers. So this will basically show you a simulation of a number of trials, a number of trades. I use the trades as days, so 250 trading days, right? Because this is what the percentage is going on the day, not the trade. So in this scenario, if you use, let's say, a 4.5k prop firm account, which tends to be 150k, advertisers 150k account, let's say my average winning percent is around 60%, and you're losing win to loss is basically 1.5. So losing 2% to make 3%, right? Commissions, overheads are around 15%. That's quite standard in this industry in futures. If you calculate that, you can see the average comes out to be around 33k, right? So let's just try and find a statistic now on the trials for 33k. So what we'll do is just try and find one. So 26 in this scenario, 26, 23, 18, 19, 26. We want about 33,000. And the reason, here we go. So 33,000. So what this is showing us in this example, if you just use, you know, the 2% standard prop firm, which is going to be very hard for, you know, risking on futures, because that is just literally 45 points on an NQ1 micro. So you're probably going to have to increase it, but hey, it will still be profitable, and your max drawdown is only 10%. But what happens is if we increase the risk to now, let's say 20%, right? So if it's 20% risk, and the profit in this scenario is obviously most likely going to have to be 30%. So if we do that 0.3 in this scenario, so 0.3. So you can see if we change this now to 30%, the numbers will be pretty crazy because it's going to compound, but we can show you. So you can see in this scenario, the maximum drawdown, the numbers will be crazy because it's compounded right at 30%, which is just wild. But you can see here, the max drawdown is 88%. What that tells me is most likely you are going to blow up. Okay, most likely you are going to blow that account if you do, you know, 20% like that. You can be successful with it. And if we just go and, you know, show the trades, for example, you can see, look at the equity curve. It is crazy. So you start at 4.5K. You can see some hit. These are the wins. These are the losses. So you can see here, you win 1,000, you lose 900, you lose 750, you win 900, you win 1,000. So you can kind of see 4.5K ends up going into a pretty large figure, you know, 500 million. It's because it's compounding at 30%. Obviously, compound interest is pretty wild, right? So if we just do that at 100, you can see here, for example, the averages are going to be just crazy because it is compounding. So 500 and 500 million, basically, going for anything higher than 15% on the maximal drawdown, in my opinion. So in this scenario, you could probably go for 7%. Let's have a look. So 7% to find the 1.5R, just divide it by 1.5. So basically about 4.6. Say 4.6 on the maximum draw on the losing trades. So we're down to around 20% if we do 100 trials to get a better average. You can see here 86K. So if we now go to one trial to get one that's averaging around, in fact that was the medium. So we want, the average is 1 million. Okay, so if we try and find one now that is showing 1 million, so 4.5, 200, 600, 1 million. So this is still too high for my tolerance. 30% drawdown is pretty high. So again, this is where it gets hard to do. So if we put it down to 5, and again 5 divided by 1.5, you're looking at around 3.3% on your risk. Okay, and like I say, it gets crazy because you are compounding these numbers. So in this scenario, you're looking at around 20% drawdown. Again, that's not too bad. That's kind of what I would be looking for, anywhere from 10 to 20% drawdown. And you can see here the average is still, you know, 220K, which is pretty amazing if you can do that on a 4.5K account. Not saying these numbers are realistic, but if you do follow the statistics and actually follow, you know, the plan in terms of the position size and etc., these numbers can be attained if you do stick to the win rate. If your win rate goes down to 55%, for example, the numbers are obviously going to go down. You can see now 71,000. So if we try and find a trial that's close to 70K, you see 8,000, 51,000. These are just examples of trials that we're just simulating. 73,000. So you can see in this scenario, your average drawdown is just under 20%. That to me is not too bad. 20% drawdown is fairly manageable. You can see, look, the chart is a bit more cleaner. Okay, so your chart is a lot cleaner than what we saw before. So this is what I use the trade simulator to kind of crunch the numbers. And then what I would do is I'd put these numbers into my sheet. So for the prop account, you know, we'll change this to, let's say 5. The risk was 3.3. So the risk here for me would be 3.3%. Oh, my mistake. So 0.33. And then the profit would be 0.5, so 5%, right? 5% risking 3.3. And you can see in this scenario, we're risking $140 or $150 to make basically 225. And you can see in this scenario, you can probably take one micro and your stop can be, or even in this scenario, you'd probably take this one here. So free trades at a 25-point stop with a profit target of 37 points on free trades. That's not too bad. You can build yourself up on that account. Once you build the account up to maybe 6,000, you can see this is where you can start. You know, you can give yourself a bit more room. You can either take one trade with 3 micros, etc., etc. Once you build the account up to, let's say 9,000, you can start taking, more trades in terms of the risk. So you can now take 5 micros, or you can take 1 micro with 5 trades. And then if you go to, like, say 12,000, you can see here gets a bit nicer. So you can take 3 trades. Anything above 10K, in my opinion, just works a lot better with the numbers. And also, I want to just add, this is where cycling accounts comes into play, because if you have, let's say, a 4.5K account, but you've got 4 of them, you know, you've got basically 4,500, or let's just say 3 of them times 3. You could have 3 150k Topstep accounts, which is 4.5k risk per account. That's free. That's 13,500. You could then have 13,500, and you can just trade one of those accounts. So you can just trade one account with that total risk, and you can be risking 400, basically nearly $500 a day to make 675. You can see here you can take 2 micros with 4 trades, and your profit is 42 points. You're risking 28. And then if you take a loss, you can maybe cycle over to the next account, take a win, cycle to another account, take a win, etc. And you can just cycle the accounts like that instead of trading them all at once. So if you trade them all at once, you're having the same risk as basically 4.5k because you're trading 3 accounts at the same risk. So you're essentially tripling the risk as opposed to just trading 13,500, but just on one account. That's where, in my opinion, the hack is. Just from my trading approach, right? Everyone else has a different trade approach. You might trade ticks, you might trade a couple points, you might be a scalper, but for me, this is how I trade. And like I say, for me, it's a lot easier to have that room, that room for error. So this is how I do it. Hopefully that's been informative and helpful. Thank you all for watching, and I'll see you all in another video.